Hello, everybody. Welcome. This is Steve Brady, partner and market leader of Withum's transaction advisory practice. We work in the M&A world, buy side and sell side, helping investors, private equity firms look at businesses they're going to acquire or make an investment in, and as well help prepare companies for sale, both privately held, entrepreneurial owned businesses, and as well private equity businesses. In addition, certainly work with larger strategic buyers who are making acquisitions in our world. So welcome today. We're going to talk about the new look of M&A and certainly weave that into the new look for private equity and how this is all impacting that world. All right, I'm pausing because the mechanics didn't work. "2021, so let's talk about the state of M&A. Certainly, having done this work for many years, the activity is just absolutely insane right now. Frankly, there is so much activity going on, and we're going to dive into some of the reasons for that. But M&A activity is at historic levels. This chart you're showing with data from our friends at PitchBook shows that in 2019 and before, deal activity was very high. There was certainly a slight decrease last year during the pandemic, immediately after, although activity remained strong throughout the year. But that fourth column, that's through September of 2021, not far behind, and certainly with the incredible amount of deals in the marketplace right now, that chart is going to be way above prior years by the time we finish this year. So just an amazing amount of activity. So let's talk about some of the drivers of that activity. And first and foremost, and really important as we not only look at 21, but looking into 22, the fundamentals are there. On the demand side, the availability of capital to make acquisitions is at record levels. Certainly what's called the private equity dry powder or available capital on the sidelines looking for deals continues to be at record levels, and that's something we've said for many years. It just continues to be an enormous amount of unspent capital. And on the corporate side, strategic acquirers have a lot of cash on their balance sheets. And again, from a availability of capital standpoint, critical and looking in both constituencies to put that capital to work. So demand is there. And then you, of course, have to match that with supply. And there's a number of factors going on in the market. Sellers are looking to sell. The pandemic had an impact, and certainly what we've seen since the pandemic started and a few months after it, it had an impact on many people's personal goals. Some sellers decided that while they were very comfortable running their businesses and maybe didn't think they were going to be in the market to sell them soon, they've just changed their life goals, and we've seen instances of that where maybe it's time to sell and not continue to work as hard as I've been working on this business. And certainly it had other impacts than that, but the pandemic definitely urged some people to enter the market. And then COVID impacted the financial and operational aspects of these businesses in, two different spectrums. One, as I phrased here, the COVID lift. Many businesses have done extremely well during the pandemic. And because of that, their earnings are supporting these record valuations that we're seeing. Sellers are deciding that because of the great results they have, that now is the time to sell. And that's had a definite impact on the supply of companies in the market. While conversely, and unfortunately, obviously not every industry fared well during the pandemic, distressed a number of businesses such as restaurants and those supplying to restaurants. As a prime example, and we've seen a lot of more distressed deals because of that coming out of that and other similar sectors. Again, fundamentals are there, supply and demand, and again, an important topic that we'll come back to. But then you take all those fundamentals and along comes the proposed tax policy changes and really just supercharge this market that we're in right now in 2021, and why the amount of activity that we've been working through preparing companies for sale and looking at buy acquisition opportunities during the summer. As we head into the fall, it's just going to be amazing, that level of activity again. And with that, going to be create a very enormously busy sprint to the finish line, as again many sellers are saying now is the time because of proposed tax policy changes. And where those changes end up obviously remains to be seen, but it certainly was a motivation and an impetus for companies, many companies, to enter the market. The other topic, switching gears, but certainly as important as we look at the drivers of deal activity in the past year and a half, the obviously incredible amount of SPACs that have been raised and need to deploy their capital within 2 years of raising those funds has created another category of buyers in the market looking for deals. It's created certainly increased valuations that they are able to pay, which has led to the whole valuation side of this equation also being at record levels in many industry sectors. I'm not going to dig too much into the valuation side, but certainly to comment, and it's not just because of the SPACs, of course, but they're a factor in it, that right now valuations and one of the reasons certainly that impacts sellers wanting to go to market is the high valuations in many of these sectors. But with that, there are some other very important dynamics at play at what's going on in M&A today. And, first and foremost on my list here is the ESG side of things. And this is an area, and related to that, the carbon footprint of businesses, and especially on the strategic side of the coin, and larger private equity firms that have major institutional investors. Weaving ESG into the investment theses, or at a strategic buyer level, looking for companies that can add to their ESG compliance and view in the marketplace is really important. It's a topic unto itself, but it's just starting to gain real momentum in the marketplace, and certainly for smaller entrepreneurial businesses. It's interesting that positioning yourself in the compliance and protocols of ESG is positioning you in a way that you can get a higher valuation multiple and frankly a wider swath of potential acquirers, because many investors are under pressure to make sure that they comply with these ESG requirements. Diversity and inclusion is also a segment of private equity that is getting attention. It's something that spoke recently at a panel on this, and the point here is it really is moving some of the investment strategies, and certainly not as big a driver in actual investments as ESG is today, but it will continue to be a topic on a lot of people's minds. With that, other dynamics, slide here says everything tech. Is just whether whatever segment of technology, and frankly businesses that are more traditional industrial manufacturing businesses, if there's a tech element to it, it's going to definitely get attention of buyers. And at the same time, many businesses during the pandemic have been able to pivot well, incorporate technology or e-commerce or other elements of just operating a more efficient business or a more efficient strategy to market, that technology is playing a big part of that activity. And as I just said, businesses have pivoted in the pandemic. I mean, it has been really interesting in many cases where entrepreneurs in particular, I'll point to them because I think they were able to pivot their businesses quickly in many cases, and what may have been a traditional industrial product manufacturer uh, switching into, not certainly while still making those products, thinking about their distribution channels, thinking about e-commerce, thinking about what technology can give them an advantage over their competitors, not only as they drove their businesses through the pandemic, but also on the other side. It's really created, again, a lot of activity in the market and a lot of interest in private equity firms and other acquirers in these businesses. And then the whole work at home trend, the final one I'll mention that's been a driver of this activity. And the point being there, obviously, it's changed consumer taste, consumer preferences, how businesses operate, and what services, products, technologies are needed to drive those businesses. So that's been, again, certainly a driver of activity and creation of many opportunities that are in the market. So let's add on to that with some of the kind of hot industry sectors, and the chart here shows over the last 4 years, again, including 2021 through the third quarter, the broad industry sectors where deals are happening. And what we're seeing again is everything technology, and certainly within our practice, fintech, ad tech, marketing technology businesses, pure SaaS businesses, and the technology that they can provide for either a strategic acquirer or a platform business for growth investors or private equity investors. The activity is continues to heat up, and certainly also within just IT services businesses, we're seeing a lot of activity there. Um, Healthcare, which is not as prominent in this graph, but we're seeing tremendous activity. Healthcare systems, healthcare providers, those that deliver products and services to those groups are seeing their businesses continue to change. And obviously, this has been a long-term trend, but the activity within healthcare is at a pace that is frenetic in many cases. Within providers, there's been a wave through different specialties over many years, and certainly certain specialties are coming online with a ton of deal activity and getting the attention of private equity investors in particular, but certainly others, again, hospital systems and the like. And our healthcare teams are certainly spending a lot of time working through those issues. You can see from the chart the B2B shift, which was more prominent in the early years, to more B2C. And again, in 2021, that's certainly a lot of that has to do with the work at home, live at work phenomenon, as well as the changing consumer preferences. So at a macro level, this is what's going on with industries, and certainly if you drill down underneath these industries, many sectors within them, just amazing the level of activity. So let's shift gears to talk about private equity's role in this incredibly active market. And starting with that, the incredible level of activity, private equity is certainly front and center, again, along with other categories of acquirers, but private equity is very active right now. And what's interesting is, among other things, that level of interest, that level of activity remains so strong from private equity, yet the multiples are very high, and strategic acquirers can generally look at a business within their industry and get synergies out of a transaction that allows them to pay a higher multiple. And certainly many times private equity won't win those bidding wars, but they are certainly full participant in high multiples. And I know many of our friends within private equity do think out loud towards an eventual exit, and can they get the type of returns they need to deliver to their investors given the high multiples that are in the market right now. Certainly over time, for many reasons we won't get into today, private equity has shown how they can get those returns, but it certainly is a big concern. But we will touch on a few of those points as we go through private equity's role here. But as we look at private equity, the second point here is it's not a category that is just doing leverage buyouts. And certainly this has changed over many years. This isn't a 2021 phenomenon, but it continues to accelerate. Many in the private capital side, uh, forming private credit funds, and those lenders, alternative lenders, are becoming a lender of choice in many private equity deals and other transactions. And again, large funds that are providing capital and serving a role that the commercial banks cannot. Private equity is increasing its involvement in PIPE transactions, which is private investment in a public enterprise. That ties into the SPAC deal, certainly. That is an element of a SPAC deal, not to get too deep into that topic, but just in general, private equity looking at additional investments in public enterprises. And certainly private equity has always had a role in growth investments, although what we've seen in that kind of middle category of investor between the early stage venture funds, which have been around forever, and private equity, which is generally investing in an earnings stream and an ongoing business that is profitable, many private equity firms forming and looking at these growth investments. Another category that we're seeing more and more of are the independent sponsors. They've been around for a long, long time, of course, but their prominence in the market is increasing. Many legacy funds have run their course, and the senior professionals are forming their own independent sponsor groups, and also there's just the ability of an independent sponsor to act in a different way than a big fund in particular is driving the importance of this category. And certainly with that, to the slightly more mature private equity industry than certainly it was around 10 years ago, many of these individuals have significant private equity experience. And so they bring a lot to the table for their investments. Looking at private equity's role in shifting into the GPs or the institutional investors that invest in these funds, they're concentrating their private equity investments. They're investing in fewer, which means their investments are larger because they still have the capital to deploy. And that will lead into our next factor in a second here. But, the other important and interesting role is that many GPs are making side-by-side minority investments in deals alongside private equity funds and or just making minority investments on their own, going direct to channel or direct to investment more so than in the past. But again, that concentration of PE investments and a number of other factors are making the bigger players, the big get bigger, and the size of these funds has certainly continued to grow over time. Not an insignificant factor that many of them are paying more attention to real estate, which is certainly a long discussion, but opening up some opportunities for middle market transactions and in many industry sectors as some of the big dollars right now are being allocated into real estate. So with that, again, private equity's role, sector focused funds are extremely important. It's again been going on for a number of years, but more and more so. The percentage of private equity firms focused in 1, 2, 3, maybe 4 sectors, if they're big enough, is very prominent that they're leading with that and being able to bring value to the industry they're investing in and that ties directly into the increase in the operating partner role within private equity firms. And, we're seeing that more and more. It's been a phenomenon that continues to increase. With that, there's unique challenges in this market, just the volume of transactions, how to get deals done, especially in the next 3 months, 2 months. It's going to be extremely interesting. Within this marketplace, just the economic conditions definitely has a factor. Certainly we don't see with our clients and other private equity investors, a tremendous concern because they're still investing at these multiples, but it is a factor in how they do deals, how they structure deals. The administration change has had an impact on many aspects of getting deals done. Certainly increased discussion around antitrust, differing regulations on how to get approvals in that manner. And certainly our legal friends who are working these transactions are spending more time on those matters, as well as financial investment in the U.S. related investments on cross-border transactions. Again, just more scrutiny there, as well as over the past 3 to 6 months, increasing scrutiny by the SEC and the SPAC deals. All of that's presenting challenges depending on the transaction in this market. But I really want to emphasize that, in this current market, deal structure with the COVID impact on businesses has been very significant. It's created more earnouts. It's led to creative structures. Many of our, again, legal friends in particular in the M&A world say this is a great time for them to practice because they truly need to be creative. And, again, the driver of this is many businesses have had a lift because of COVID. And as an investor, you need to invest off the sustainable earnings stream. So structure is one way to accomplish that. And conversely, obviously, on the distress side. More of a factor early in the pandemic, but certainly still, given the availability of capital, many times just funding these deals with all equity, although certainly the availability of debt is an important factor in this whole market and one of the fundamentals. So that it's not difficult to get them financed, but it is an interesting option in many deals to get deals closed early. So what's next? As we look into 2022, I think the important factor to keep in mind, again, is the fundamentals. The supply is there. There's nothing on the horizon short of some cataclysmic shock that's going to change the fundamental supply of businesses wanting to go to market. Again, many of them pivoted during the pandemic, and because of that, they're still playing out the operational changes to these businesses and will be positioned and have some runway in a year or two that will provide the earnings that will allow them to have a successful exit. Certainly our business, as I said at the top, we work about half on the buy side, half on the sell side, and we're continuing today to see and field calls for companies coming to market, which means these are Q1, Q2, 22 deals. We see that level of activity continuing. Our friends in the investment banking world are seeing opportunities. So the fundamentals are there for a strong market into 2022. I think fortunately for many of us who are in these transactions, what will go away is the tax policy change, threat or reality. When we go into 22, we should hopefully know what that will look like. And because of that, the supercharged nature will go away, and certainly don't see 2022 being as busy as 2021. But with that, the fundamentals are there. And again, that all has to work with the demand, the capital. Private equity firms remain having tremendous capital in play, strategic acquirers are profitable and their balance sheets are strong. So as we look into 2022, both those factors combine. It should be a strong year, but fortunately a little less crazy. Thank you.